What's going on, everybody? It's John here. Do some videos on investing. You're going to see some videos on credit. You're also going to see some videos in here on adventure travel because I've got to do something besides just sit inside and work all the time, right? Love to use my credit card rewards points and my United Miles to do some exciting adventure travel all over the world. You're also going to see some videos on active living and some videos. Actually, recently, it's pretty much the end of June 2021. And we are right in the thick of the busy short and medium term furnished vacation rental season. And, I've got basically three places I do that on here in Southern California and starting to do more content on that. But what do we have? We've got a very exciting video today on investing. And the reason I say it's so exciting, well, every video is exciting, right? But basically, what we're talking about is I've finally come down with basically my 10 favorite stocks to 10x. And I'm just going to keep it super general to 10x over the next 1 to 10 years. I mean, I guess there's a chance that a stock could 10x, in less than a year, but not that likely. I personally am an investor. I'm not a trader. I really enjoy investing for a lot of reasons. I really like to be on that ride, but it's really kind of what I have had success with, and it's what I've kind of developed my own systems with that make the most sense to me. To give you an example, I invested in Netflix. If you've seen some of my videos, you probably know this. I invested in Netflix in 2011, and at the time, Netflix had basically a $3 billion market cap and $3 billion in sales. So basically, instead of just looking at like, oh, okay, well, what are these tech stocks that are going to 10x? What I did is I took a look at all these businesses and various ways. It's been months now of really kind of tearing into this, but basically looked at a lot of different of course publicly traded companies, and outside of some general criteria I took a look, and instead of saying okay what stocks are going to 10x, I said what of these companies what is most likely that their revenue can 10x in the next 1 to 10 years. And if you actually I didn't really do that when I purchased Netflix in 2011. It was really simple. I mean, it's just nothing more than looking at their valuation at the time, understanding what their gross profits were, which were very attractive, and understanding kind of what their market cap was, and seeing that it was, had a lot of value to it. And I just love the service. I mean, it's really just came down to the fact that it appeared to have a great valuation. I love the service, and it seemed to have a ton of growth. So, basically of these 10 that I look at, I'm looking at the probability of all the companies that I'm looking at, the probability of the ones that have the greatest chance of 10xing in their revenue. In terms of my example of Netflix, you take a look at it, and at the time that I picked them up, they were doing about their full year 2011 was $3 billion in revenue or sales, right? And they're not doing $30 billion yet because it is 10 years later, but their stock has certainly 10x, or more. I'm actually, ever since my purchases in 2011 and 2012, I've got an 80x return on Netflix, those Netflix shares that I held on to, when you look at the 52-week high, of Netflix. And I certainly have, sold some Netflix and purchased some over the years, so definitely have some returns underneath that. But my highest return, which are the initial shares, are an 80x return. So the point is the stock can certainly move a lot differently than the revenues, right? So, but if you can be along that ride for as the revenues go up, you're putting yourself in a great position to actually, be able to be a good investor with that stock, right? So I've come up with 10, like I said. And another point I kind of want to make is I've spent a little bit of time. I mean, got very fascinated with venture capital, and I spent a little time, got a little article here from the Harvard Business Review on venture capital. And what I kind of want to point out is number one, kind of going after growth companies right now in this day and age, when, at least for me, because I've developed a pretty nice little system that I have that works for me, but it really is the best way for you to, for anyone really, to really achieve a really high return on their capital. And this is because, I mean, if it's not working out, you can just sell the shares. I mean, I realize that's easier said than done if the market, really, really goes down. But the fact is if you select 10 of them and you have even only a couple $100, you can put money in 10 of them, unless of course it's a really high, the share price is really high. Let's just say at least $1,000. You can put money in all of them, and if you're just not liking how it's going, you can you can sell some of them. You should be able to at least sell some of them without taking a beating, right? And the reality is venture capitalists can't do that. They can't. For them, the way it works for venture capital is number one, they actually need to. They have a figure of in between 25 and 30%. So they need their funds to return 25 to 30% of a yearly return to actually make it worthwhile. Now, going into that, they actually know with all their investments that there's going to be a lot of losers that they invest in, right? So if you, again, if you were a venture capitalist, you're going to go into it and you're going to know that basically it's only about 20% of your investments are actually going to give you a return, right? And the venture capitalists know this. I can actually point this out to you on the Harvard Business Review, which I will show you in a second here. But where I'm going with this is, number one, I guess I'm a little bit different. I've been an entrepreneur for a while, and I took some learnings that I have as an entrepreneur, which is really gross profits and the importance of gross profits. And I applied them to, investing in growth companies. And it's really worked out for me. And I've kind of been doing this a while, right, for a long time, actually investing since 1989. But also, I picked up Apple in 2007 before the first iPhone came out. And I've had the system since about then. So that's certainly, a while. But the reality is that, let's just say in the example of 10, if you have identified 10 stocks that work for you, that you really think that they're growth stocks, and I realize saying half of them doing something, but they've already made it to becoming a public company. So they already have quite a bit going for them, certainly more than the companies that the venture capitalists look at and the angel investors. So let's just say hypothetically, to make the numbers easy, half of them, work out for you. And let's say, 1 to 10 years. And I realize 10xing is kind of a very aggressive goal, but just to keep the matter simple, if you could, 5x or 10x those positions in the next 1 to 10 years, what's going to happen is the ones that don't work out, you could just hold on to them, or you could kind of trim some of those positions and you could increase the exposure on your winners, or you could keep developing that system, developing that system just like the venture capitalists do, where you're always on the hunt. And as long as 50% of your picks are actually working out for you, keep reinvesting in those and then trimming your losers if you want to get rid of your losers and going and finding those 10 new gems, right? And the reality is that for me, I've actually achieved over a 35% return pretty consistently, certainly since 2017. And, one of the spirits of this video is also the magic number of 35, right? So 35%. So if you're achieving 35%, number one, you're actually beating the venture capitalists. Number two, you're beating the pants off the S&P 500. And then number three, the most important thing is you're actually more than doubling your capital, not considering any sort of withdrawals, right? You're more than doubling your capital every 3 years. So, you go 10,000 to 100, 10,000 to, over 20,000, in 3 years. If you make those numbers bigger, 100,000 to, over 200,000 in 3 years. And if you keep doubling your capital, you'll get to a point where, really for anybody, it might be kind of hard to outspend the capital that you have. And that's really the goal. And that can be done with actually growth stocks after they, after they IPO and before they become, kind of like I would say, it's probably ideal when they're a mid cap, right? That 2 billion to 10 billion figure, but before they become a large cap, and then certainly before they become a mega cap. Mega cap meaning anything over 200 billion, and then a large cap is really over 10 billion. You're not going to, some of these opportunities are just, they're just going to be, you're going to go in as a large cap, and that's just the way that it is, right? But let's go ahead and take a look at what some of these picks are. In fact, what I'll do is I'll just show you real quick the Harvard Business Review in terms of what I'm talking about. So we go right here. Given that, and again, this is the way that Harvard Business Review describes venture capital. Given the portfolio approach and the deal structure VCs use, however, only 10% to 20%, I said 20%, 10 to 20% of the companies funded need to be real winners to achieve the targeted return of 25% to 30%. In fact, VCs are often built on one or two good investments. So we can go into more detail. I'm just giving you like kind of, the nuts and bolts of the way it is in venture capital. So you pretty much heard everything that my point was they're trying to achieve on average 25 to 30% per year. Granted, they're investing big dollars, right? But you could still start with a couple $100 or $1,000 and work your way up and start really growing your capital if you're beating the VCs. And knowing that only 10 to 20% of the companies funded need to be real winners for them, and all their winners actually pay for all their losers is the way that it works in venture capital. So let's go ahead and hop into what is the handy dandy spreadsheet, so I can show you what these picks are. So these picks I'm going to show you again. I've been working on this for months and months and months. I'm not going to do a specific order. What I'll do is I'll save basically I'm going to save my two favorite for last. Okay, so all the others, it's actually 10 that I want to choose, but I really chose 11 because I can't. There's just some that I just can't not include, right? So let's go off here. So I'm not going to actually go into Yahoo Finance and show you any sort of graphs or whatever. I'm just going to go to what I call my handy dandy spreadsheet. And the way that I organize the handy dandy spreadsheet, everybody, is and again, not that many people have seen these videos yet, but this is some talent that's actually worked out for me. Like I said, I've been have a little system that's worked for me since 2007. So eventually I think it's gonna people are gonna catch on to some of these systems. But I organize it according to revenue, the actual largest revenue down to the smallest. And like I said, I'm kind of reverse engineering this a little bit, and I'm looking at what companies have the highest probability of actually 10xing their revenue. And you do have a higher risk when you go for the lower growth companies, but those are your opportunities, right? If you're going to try to beat the VCs and you're trying to do better than them, if they do 10%, if you're trying to do, 50% is a little aggressive, but if you could at least beat the VCs in 20% of your selections, basically are your winners, then you're beating the VCs. And then if you can achieve better than a 30% return, you're beating the VCs. And if you can consistently achieve that 30% plus return, you're going to be doubling your capital, not considering withdrawals, of course, every 3 years, right? So so let's take a look at the top picks here. Again, I'm saving my favorite two for last, everybody, okay? So I'm going to start with the biggest ones, right? So the biggest ones, here we go, is Docusign. Oh, you know what? There's something else I wanted to tell you too. The magic number 35. So some things that are really important to me are gross profit margin percentage rate, and then also year-over-year revenue growth. So the reality is as long as those are the minimums, right? You got that minimum year-over-year revenue growth of 35% or higher, and then you got that minimum gross profit percentage of 35% or higher. A lot of these that I like have gross profit margins of way over 35%. The reality is it's going to be hard for you to find, a pick, a stock or a company that really meets all your criteria, even for me. I try to get them, before they're actually $1 billion in sales, and certainly try to get them before they're 20 billion in market cap. If you can get them before they're 10 billion in market cap, that's great too. But again, so let's go ahead and take a look, because some of these might actually have some year-over-year revenue growth, which is actually lower than 35%. Like for example, Roblox and Wix, it says lower than 35, but that's really just because I'm not necessarily comparing fiscal year end to fiscal year end. A lot of times what they'll do is in Yahoo Finance, they'll say trailing 12 months, and that's not really fiscal year end. It's not really a true year over year, right? It's kind of like a quarter of a quarter in some cases. But anyway, so all right, so the number one on the list is Docusign. And again, I do really look at the numbers, everybody, but I do ultimately, when those decisions come from me, it comes down to a gut feel after a rigorous review of those financials, right? So we got Docusign, basically here we have, and gross profits just over $1 billion. They a year ago, their most recent fiscal year end, they're at over $1 billion in sales, almost 1.5 actually, and then the fiscal year before that is when they actually were a little bit under that billion, right? We have very high gross margins at 76%, and then year-over-year revenue growth here for Docusign at 46.82. The next one in the mix is Roblox. I was a little hesitant because Roblox is a little thick at 50 billion, but the growth is kind of out of control. You can't really see that from this figure because Roblox went public in March, so their numbers are a little bit, I'm not really clear on how they report them. When they show like trailing 12 months compared to fiscal year end, it's a little bit wonky, but their year-over-year revenue growth, according to their investor the investor area on their website are actually a lot higher than that. So this is more like, taking a look at trailing 12 months compared to fiscal year end. So their year-over-year revenue growth is really strong. And then all aspects of their company have very, very strong year-over-year revenue growth. In fact, they're in a lot of cases reporting a lot of month-over-month growth figures that are really strong. But Roblox is in there. Definitely not one of my favorite because it is a little thick at about 50 billion, but at the same time, really high gross margins at 74% or higher, very strong year-over-year revenue growth, and then that market cap of 50 billion. The next one of my favorites certainly is Etsy. Etsy has not done that much actually, certainly this year at all. Growth tech really took a dive starting in the middle of February, and Etsy was right there along with all that. But certainly love Etsy. One of the highest year-over-year revenue growth figures of anyone in the group. It says here 68%, but if you take a look at when they reported their fiscal year end 2020 compared to fiscal year end 2019, it was almost 100%. So really one of the highest on the list. Their market cap is a little bit higher than this because when I last did this, Etsy's kind of popped quite a bit actually, literally in the last couple of days. But still, they're at about a $26 billion market cap. So super duper in love with Etsy. It's right up there, right? The next one is Wix. Not as madly in love with Wix as others, but you really can't discount the concept of Wix in terms of really being able to go in and make it easier for smaller businesses to create websites. I actually use that for my business, for my internet marketing business. I use a different company called ClickFunnels. They're not a public company, so there's no way to invest in them. But if you take a look at Wix, same thing. They got some kind of, a little bit wonky looking growth rates, but that's just because of the way that they reported trailing 12 months over a fiscal year. But they are certainly followed by a lot of analysts, and I really like the idea of Wix. Here they are at 14 billion market cap, really nice, gross profit margins of 65% plus, right? So in case you don't know, Wix is really as simple as you want to go get a website, put your domain there, and then anybody can start building. You don't have to hire, coders and all that stuff. You just build your own site, and it's pretty easy. The next one really like is Zen Desk. Here we got Zen Desk. Zen Desk, in case, stock symbol Zen. In case you don't know Zen Desk, basically just cloud-based customer service, customer support tickets. Like you have some sort of a business and you want to outsource that B2B solution. There's your place, Zen Desk. Zen Desk has been around a long time too. They recently hit $1 billion in sales, and that actually is one of the criteria that I really like for growth companies is if they've recently hit $1 billion. And really attractive gross profits at 60-75% plus. Some really nice year-over-year growth. Again, they don't have that 35%, but I still like them. 26% is still better than some in the mix here, but anyway, that is just one thing that I guess I'm not as in love with them as some of the others in the top 10. The next one is Hubspot. Hubspot really helps anybody with really anything related to internet marketing, social media management, or just anything to do with really anything related to internet marketing or any sort of getting your face out there, or your big business, small business, tiny business, medium business on the internet, and that's Hubspot. A little bit thick here at about a $27 billion market cap. They are not at $1 billion in sales yet, which is actually pretty cool because, again, I do think that, the reality of them being able to 10x their revenue and go up to something like, 9 billion from under $1 billion is most likely in a smaller group like this over the next 1 to 10 years, right? Probably the highest gross profits in the bunch here, 88.5% gross profits. 30% year-over-year revenue growth, and again with HubSpot, not really at that 35% figure that I like to see, but again, it's going to be hard for every single, to find like companies that hit every single mark that you want them to hit, right? The next one in terms of my, my top 10 here is Upwork. Upwork is certainly looks very appealing. Certainly a lot of growth for them. Here they are, Upwork at, when I did their numbers, it was a little bit different. I think their market cap is a little higher right now. I think it's more like 7. Yeah, it is. Their market cap is more like 7 right now. And again, when these stocks go up fast, they can really change their market cap. Pretty low revenues at about 373, so not even 400 million in revenue from a fiscal year end point of view. Really nice gross profits right there at 70% plus, 72%. and 24.33% year-over-year revenue growth. So again, don't check all the boxes. I mean, I think with Upwork, that's like super duper company related. I mean, I think it's great. I use Upwork a lot, for my business and marketing needs. And then another one I'm super excited about is Asana right here. And in case you don't know what Asana is, it is really basically for an individual, a charity, any sort of business, project management solutions. I actually had a project management solution save my butt in a real estate deal that I was working on. And it was not Asana, but I have used Asana in different areas. But, you look at Asana, really, really attractive, some of the smallest revenues in the group, second smallest revenues in the group, which is great because that's opportunity for you to, kind of climb on before they get, bigger, right? At 227 for a year, 87% gross margins, and almost 60% year-over-year revenue growth. Asana, again, it's pretty much for anyone, any business, any person to go in there and launch a project management solution for free. And it's certainly heavily followed by a lot of analysts. And the last two, which are my favorite, I'm going to start actually with Roku. Is probably my highest conviction name. The thing with Roku is it's kind of gotten a bit. I mean, it's up like literally almost 40% in June here. So its market cap is changing a lot. But I think that their market cap is now 60 billion. It's not 43. It's now 60 billion, right? With respect to the most recently reported fiscal year end numbers at 1,778,000,000, right? Very attractive. Let's go a little bit lower. Gross profits at 45%, so certainly checks that box in terms of 35% or better. Would personally like to see higher gross profits, but what's going to happen is as Roku really becomes a much bigger company, they're going to be getting a lot more advertising dollars in that will affect that and bring their gross profits up is what my feeling is. And then year-over-year revenue growth of 57%. So Roku's has been for a long time and continues to be one of my highest conviction names. And then my favorite in the whole group, right here at the bottom, everybody, the smallest revenue, well, outside of Churchill. And again, there are some that I didn't choose everybody because because their numbers are wonky. One of them, like Churchill Capital, who's the shell of Lucid Motors, they have no revenue. So, I don't know. I kind of have to be able to look at revenues in order for me to make an investment. So that's just something that I just can't really just buy yet. But the smallest revenue, under 200 million a year, 190 million a year is Fiverr. I have used Fiverr a lot for many, many, many years. And there's something that was really compelling to me that I read about Fiverr recently. And what that is, I'm going to go ahead and tell you. So what that is with Fiverr is it took them from the inception of their company, which was in 2010, I'm fairly certain, until February 2020, to actually distribute 1 billion, to actually generate and distribute to their sellers $1 billion in earnings. Then the next billion they generated and distributed from February of 2020 until May of 2021, $1 billion. So you figure that's 10 years of generative earnings and then distributing to their Fiverr sellers, 1 billion, and then that same amount of, like literally within 1 year, basically that next year after February 2020, that same $1 billion they generated, and released to their sellers. And everybody, that is massive, massive growth. And I just can't seem to stop my uber excitement for Fiverr. Here we are at 77.5%, year-over-year revenue growth, astonishing 82.11% gross profits, and a market cap at about 7 billion. It's actually, the Fiverr stock is not heavily traded, so it can be a little tricky to get in there depending on what trading platform you're using. I use Merrill Lynch a lot, and it's like I have to actually call it in, which is kind of a bummer. But those are my 10, everybody. Oh, and the last one, it's number 11, and I really do like this one. And I didn't highlight, I'm going to go ahead and I'm going to bold it right now, is Bumble. I can't leave Bumble out of the mix. I just can't leave them out because I just feel like the reality of Bumble, it's a whole lot more likely than not that their revenues are going to 10x between the next 1 to 10 years. Right now, tracking under, their most recent fiscal year ended under 500 million, 489. Beautiful, beautiful gross profits at 71%. They're doing things that dating companies have never done. You can now find friends on there. You can find business people, colleagues, contacts. So I really think, and again, Bumble did not work for me when I was single. Just because it didn't work for me doesn't mean that I don't believe in it, and I want to believe in it. I just think that I don't want to get too much into my philosophies about Bumble, but basically, I have to have it in the mix. So instead of giving you 10, I gave you 11, and Bumble is definitely, it's not as high conviction for me as Roku and Fiverr, but it's right there in the middle of the pack, and I can't leave it out. So there you go, everybody. So those are my hot 10 hot stocks, which are the turbo growth stocks that are going to 10 that could 10x in the next 1 to 10 years. And again, I reverse engineered it, and I looked at the companies that are most likely to 10x their revenue, and the magic number of 35. So 35% is that minimum for gross profits, and 35% is that minimum for year-over-year revenue growth. Hopefully you guys like that. If you want to see more like this, let me know. It's 100% free to hit that subscribe button, 100% free to hit the like button, 100% free to put some comments in there. The next one is going to be my 10 favorite stocks, which are not quite as hot as turbo growth, but kind of like larger cap growth stocks. And I'll do that one next. But again, you take this, you could take, whatever you want. Like for me, let's say you have 100K, you could put 5K in each of the 10, which is 50, and then the other 50 could be just an ETF. And if the winners if some of them start to win for you, maybe you could increase your exposure. And if the others kind of go down, you could always trim them and sell them in a matter of, a couple seconds in any given trading day. Hopefully you guys like that. If you did, like I said, give me a like, give me a subscribe. I also put some links in there. I came out with a blueprint recently where I do cover actually investing and a lot of different things with credit. Just a little bit about me, everybody. I know I told you this is a long video, and I told you before, but basically my first job out of college was Merrill Lynch. I did investment banking after that. I worked for Sun America here in Los Angeles for 3 years, which is an investment company. I also, I've been investing since 1989. My first, I started buying Apple in June of 2007 before the first iPhone came out. I got a 33X on that. And then I picked up Netflix, started buying Netflix in 2011, and I've got an 80X return on Netflix. And then I picked up some Amazon back in 2014 when their stock was down almost $100. Per share in one trading day, and that is actually 10x for me. I've got a whole bunch of other singles, doubles, and triples, and even more, which I don't really have any sort of document on that or whatever, but I can always do videos on it or let you know if you want to ask me. So anyway, I'm going to put some links in there, everybody, if you want to check out my blueprint where I come out with lots of different things for credit and investing, and those links will be below. Thank you very much, and have a great week.